Welcome back to Question Time at Alhambra Investments. You see Steve, you see Joe. We're all here today. And I think this is going to be kind of a short edition today, guys, because I know we're going into the holidays. But Joe, I know that there were some things going on that I think maybe concern you a little bit, might be the best way to describe it, to see what investors have done in the month of December.
Yeah, month of December has been pretty grim outside the Nasdaq and the S&P 500. Anything outside that, small cap, mid cap, international, doesn't really matter at all. Got hit pretty hard this month. Part of that is, I suppose, interest rates did go up during the month, and that does have an impact on those things. Apparently, it doesn't have an impact on Nasdaq or S&P 500 growth stocks. It's not the way I learn things, but that's okay. Anyway, look, this is the end of the year. As you guys know, I took the month off from writing. Doesn't mean I'm not working, and we are working on some. I'm working on a beginning of the year piece, which we always do. I don't like to call it an outlook because I really try to come at things with an open mind. I think everybody wants to try to predict the future, and we really don't do that. But it's an interesting time right now, I think, and I think it's these next few years, even the next year maybe. I think it's going to be important that you have, an honest to God strategy other than I'm going to buy these big growth stocks. Um, it feels like that end of the year here that people just kind of gave up on everything else except for the Mag 7 and so forth. Um, it is this gambling mentality that's taken hold in not just markets, but in society more generally, that really has me concerned. And I think that it's not a time to give up on diversification. It's not time to give up on all the things that have worked historically. Although, frankly, it's been tough if you're trying to be a diversified investor and do those things over the last 10 years. It's been a difficult row to hoe, as we say down south. But it is what it is, and I just think that what I've spent this time doing is looking at a lot of things we've looked at before and just bringing them up to date. The concentration of the S&P 500 is something we've talked about a number of times, and it has just gotten more and more extreme, where now really almost half the index is in something that's technology related, and really a quarter of the index sits in just four stocks. When you got 503 stocks in the whole index and four of them take up a quarter of the whole index, that's pretty extreme. I don't know how those things are going. Well, I think I do know how those things are going to end, but I don't know when. And that's very frustrating because you're trying to do the right thing and we're trying to meet a fiduciary standard that's difficult to do in these markets when everybody's interested in gambling and making a quick buck. It's not what we do. It's never going to be what we do. We continue to stick to fundamentals and actually investing. It doesn't pay off as well as gambling sometimes, but it is what it is. Anyway, look, it's just working on a lot of things this month as far as research and trying to look to next year to look where we are right now. And I think it's interesting. Today we got one report. Well, actually, we've gotten a couple more economic reports, but the main one we watched this morning was the Chicago Fed National Activity Index. It ends the year at minus 0.12, which means that we're basically growing at trend. And it looks like, 2024 overall GDP growth is going to be somewhere around 2.5 to 2.7. That is right on trend, basically. And not what anybody expected at the beginning of last year, I don't think. But, we stuck with our guns all year long that we were not having recession. And it doesn't look like we're going to have one right now either. There are a lot of new things coming in the new year, though. New administration, new policies, new people. Going to be an interesting year, and we plan to be there for the whole thing and bring you our view of it. Put it that way.
Steve, what are you looking at going into the end of the year?
Yeah, I would, not to just be an echo chamber here, but it's pretty much the same things as Joe. I mean, I'll just kind of bang the drum on this concentration issue because it's not the first time we've seen this story. Well, for a lot of people in their investing lifetimes, some of the professionals running things, that yeah, maybe it is. But in 2000, we saw a market with crazy concentration around tech stocks. The Nifty 50, I mean, okay, that market's a little long ago for my time, but I can still crack open a book or Google or and see we have had these times where you just get crazy concentration. You get investors just piling in a relatively small number of stocks, them getting to dominate the market, them seem to get detached from valuations, underlying business fundamentals. Um, I can remember in 2000 sitting down with friends or family that were in Cisco at trading at over 100 PE and explaining to them what a 100 PE meant. Cisco is a great company, but the valuation was insane. And we've always seen, economic reality reassert itself, and I think people really need to be careful out there. This goes until it doesn't, and when it doesn't, there's a saying that goes up like an escalator and comes down like an elevator. The stuff reality can reassert itself pretty fast. How fast? I don't know how fast it's going to be. I mean, 87 gave us a kind of a taste of like how fast. And that's like an elevator with the cables cut. Doesn't mean that's going to happen. But I would just caution people. It's almost like you've got two markets out here. One market that's super concentrated in just a handful of big mega cap stocks. Be careful out there, because you're trading at these multiples. I'd say you're trading rather than you're investing. You can make money at it, but it is, to Joe's point, I think more like gambling than investing. It has been where most of the performance is. It has been where most of the upside is. It has been exciting. Um, but man, I would be awfully cautious of putting most of your portfolio. Yeah, and I'm sure we'll be talking about this more as we go on, but I would just kind of give that warning. Just because somebody says, "Hey, you're investing in the S&P 500," it doesn't mean it's a diversified index if it's cap weighted. You're gonna get about a third of that index in just like 10 stocks or so. You're not getting diversified. You're getting some monster exposure to some stocks that are trading at multiples that are in line with past times where we've had lost decades in those stocks. And I could go on to this for a while, but when you're looking at the market, I would look at it as almost two different stock markets. And really keep that in mind, especially if you're investing for your retirement. Um, that we've seen this kind of story before, and it typically hasn't ended. Well, it's never ended well. Maybe this time will be different. I don't think so. But be careful out there. Kind of a Yeah, Bob. You've done the Hill Street Blues line. Be careful out there. Well, I'd say with investing, if you're playing around with some of these mega cap stocks, be careful out there.
So, like you, we're going to take a very slight Christmas break. And Joe, why don't you wrap us up today?
Yeah, I just want to say to everybody that's listened to us this year ramble on about things. We do appreciate you guys showing up and encouraging us to explore your questions. And we look forward to it next year. I think it's going to be a fun year. Maybe not fun. Let me put it differently. It's going to be an interesting year. May you live in interesting times. Well, I think we are definitely getting that. But I just want to wish everybody a happy holiday. Go enjoy your families. Try not to think about this stuff for the next week or so. And we'll come back next year and we'll hit it again. And so I hope everybody has a really good holiday.